Today we're going to be speaking about a piece of legislation that was put into the Tax Act that was passed at the end of December last year. It's called the Opportunity Zone, and basically all these presentations should be on your screen in front of you. An Opportunity Zone were added to the tax code by the Tax Cuts and Jobs Act 2017 as an economic development tool designed to spur economic development and job creation in distressed communities by providing tax benefits to investors committing capital in those communities. Opportunity zones are located in all 50 states, the District of Columbia, and 5 U.S. possessions. Localities qualify as opportunity zones if they have been nominated by the head of each state, the district, or possession, and have been certified by the Secretary of the U.S. Treasury, being their delegation of authority to the Internal Revenue Service. So, in a nutshell, these opportunity zones are economically distressed areas or areas that are contiguous to these economically distressed areas that the states, districts, and territories are basically telling the federal government, hey, we could use a little help here with some private investment. Qualified opportunity zones can be found in the Federal Register at Internal Revenue Bulletin Notice 2018-48, or there's a website here, which everyone will be getting the handouts after the presentation, where you can go into this website and download an Excel spreadsheet that has about 9,000 lines to it that will list all of the opportunity zones. An overview of the opportunity zones is basically it allows for a deferral of reinvested capital gains. It allows for a potential step up in basis and a permanent exclusion of a portion of the deferred gain. There are also related party rules put in place to prevent any type of an abusive strategy to create the capital gains to be used as capital invested in the opportunity zones.
Just to add a little bit more to that slide, the Treasury also stated that it's short-term and long-term capital gains that will be allowed to be reinvested. So if you have depreciation recapture, whether it's 1245 or 1250, which is deemed to be ordinary income, that can't be deferred, and that tax will have to be paid currently. If you have unrecaptured 1250 gain, that is going to be considered able to be deferred. Also, if you look at the slide with related parties, the investor can't sell any property to a related party. They swapped out the 50% rule for a 20% rule to generate a gain to invest into a fund.
So essentially there's two types of vehicles. There's one, just the opportunity zone itself, where people can do a direct investment. That's probably not feasible for many people. So there was also something created which was a qualified opportunity fund, where the fund will invest in the qualified opportunity zone. A qualified opportunity fund is an investment vehicle that is set up as either a partnership or a corporation for investing in eligible property that is located in a qualified opportunity zone. To become a qualified opportunity fund, an eligible corporation or partnership self-certifies by filing IRS Form 8996, in addition with its timely filed federal income tax return. So there's no initial certification that needs to be done. As long as you're in the zone, you fill out this tax form and you file it with your either partnership or corporate tax return. The qualified opportunity fund must invest and hold at least 90% of its assets in qualified opportunity zone property, determined by an average of a percentage of qualified opportunity zone property held in the fund, measured on the last day of the first 6-month period of the taxable year of the fund, and on the last day of the taxable year of the fund. An LLC that chooses to be treated as a partnership or a corporation for federal income tax purposes may be organized as a qualified opportunity fund.
Just a couple of things with regards to this. Discussions with regards to LLCs was discussed for quite some time. The proposed regulations that came out in October, in fact, clarified that and does allow LLCs as long as it's treated as a partnership or a corporation, so a single-member LLC will not qualify. And the other area that they talk about here with respect to the average, you know, if you start a fund in the month of October and, you know, you have to do the average as 6 months later and then at the end of the year, obviously this is going to create a bit of an issue. So you have to really look at the timing of when you set up that fund, see whether or not you can meet that criteria and maybe defer it instead of doing it in that late time period at the end of the year and start it out at the beginning of the year.
So when you set up this qualified opportunity fund or you invest in a qualified opportunity zone, you need to invest in qualified opportunity zone property, which means property which is qualified opportunity zone stock, qualified opportunity zone partnership interest, or a qualified opportunity zone business property. We will go through each one of these things. Qualified opportunity stock means any stock in a domestic corporation if such stock is acquired by a qualified opportunity fund after December 31st, 2017 at its original issue, meaning directly or through an underwriter from a corporation solely in exchange for cash. As such time the stock was issued, such corporation was a qualified opportunity zone business, meaning that it operated or will be operating within a qualified opportunity zone. During substantially all of the qualified opportunity zone fund's holding period for such stock, such corporation qualifies as a qualified opportunity zone business. Again, essentially in a nutshell, what it means is if you acquire the stock of a business that's going to be operating in the opportunity zone, they must operate within that zone.
And one thing to kind of mention here too as well is that if you look at the regulations, the entities that are allowed to operate under this is a C Corp or a partnership or an LLC treated as either, and an S corporation is not an eligible party.
Qualified opportunity zone partnership interest, kind of similar to stock. Basically means any capital or profits interest in a domestic partnership if such interest is acquired by a qualified opportunity fund after December 31st, 2017 from the partnership solely in exchange for cash. At the time such interest was acquired, such partnership was a qualified opportunity zone business, and during substantially all of the qualified opportunity fund's holding period for such interest, such partnership qualified as a qualified opportunity zone business. So again, you have to basically be operating within this qualified zone, and you must stay in the zone and conduct your business in the zone.
And one other thing to mention is the definition of substantially all in number 3, where they talk about substantially all, whether or not it means 70% or 90% as defined in the proposed regulations. We'll get into that a little bit later, but substantially all generally means 70% of the property held by the business and is determined by, if you have a financial statement, it's determined by the financial statement basis, or if you do not, then it's determined by the original cost.
So let's talk about what qualified opportunity business property is. Qualified opportunity zone business property means tangible property used in a trade or business of a qualified opportunity fund if such property was acquired by the qualified opportunity fund by purchase after December 31st, 2017. The original use of such property in the qualified opportunity zone commences with the qualified opportunity fund, or the qualified opportunity fund substantially improves the property. Keyword, substantially improves the property. And during substantially all of the qualified opportunity fund's holding period for such property, substantially all of the use of such property, was in the qualified opportunity zone.
And the one thing to mention here is that it cannot be, as it's stated above, that you have to acquire it for cash, has to be in that zone. You cannot be acquired from an existing shareholder or partner.
So let's just talk a little bit about this substantial improvement piece. So property shall be treated as substantially improved by the Qualified Opportunity Fund only if during any 30-month period beginning after the date of acquisition of such property, additions to basis with respect to such property in the hands of the Qualified Opportunity Fund exceed an amount equal to the adjusted basis of such property at the beginning of such 30-month period in the hands of the Opportunity Fund. In a nutshell, you acquire something for $100, you have to put in at least $100 to substantially improve that piece of property in order for it to qualify.
Unless it's real property, in which case you have to bifurcate it between land and building, and you only have to reinvest 100% of the piece that gets allocated to the building.
So now, where would you be using this qualified opportunity zone property? You would use it in a qualified opportunity zone business. A qualified opportunity zone business means a trade or business, one in which substantially all the tangible property owned or leased by the taxpayer is qualified opportunity zone property. Two, at least 50% of the total gross income is derived from the active conduct of the business in the qualified opportunity zone. And that's an area that is open. We'll discuss that a little bit later. Three, a substantial portion of the intangible property is used in the active conduct of that business. Four, less than 5% of the average of the aggregate unadjusted basis of the property is attributable to non-qualified financial property. So again, there's some more items that people are kicking around, and services kicking around as to what exactly that means. And last, the business cannot be a sin business. So it can't be related to gambling, horse racing, alcohol sales for consumption off premises, massage parlors, hot tub situations, tanning, all of those things, and also country clubs. So basically that just hammered out what the actual law is at a very high level. Now we're going to talk about some of the unknowns. Some of them have been addressed through proposed regulations, which were issued at the very end of October. Others still remain open to this day. So the first open item is we got partnership level gains.
The partnership level gains, it was actually addressed in the proposed regulations, and the partnership can make an election to defer the gains. However, the partnership doesn't have to do that. Each individual partner may elect to defer the gains on its own. So you have to look at it, see whether or not it makes sense for the partnership, depending upon how many partners it has, to make that election, or to allow the partners at their level to make that election.
The second potential unknown is sometimes partners don't know that there was a gain at the partnership level. So Alice will explain a little bit more regarding that.
So what the proposed regulation said is that if the partnership is not going to make the election, and let's just say that the partners aren't aware of it, or they find out, late, what could we do to help out the partners to get a timely election made? So in the proposed regulations, where the case of the K1 interest in the partnership, the individual partner has 180 days from the last day of the partnership's year end to make the election. So they don't have, the partnership can make it within the 180 days of the sale, or the partner can make it either at 180 days from the sale, or if they choose to, 180 days from the last day of the partnership tax year.
Another item that's been kicked around is, we all know that if you take your deferred gain and you invest that into a qualified opportunity fund, but what happens if the opportunity fund then has a gain?
There's a lot of discussion regarding this, and the proposed regs did answer some of it. It says that if the sale is in the qualified opportunity fund and there's a gain recognized, that you can roll over that investment into another qualified opportunity fund, but it mentions only if there's a gain recognized. So if they're taking all of their profits or whatever and they want to roll it into another fund, they can do so only if the gain was recognized. And if you look at the literal reading of the regulations, it was very unclear as to whether or not, this was going to be allowed just to be deferred as opposed to only that which gain was recognized. And there were people that were talking with Treasury, and they were a little bit unclear as to the outcome of that, but the proposed regulations did address that issue.
Another area which we talked briefly about before is basically, again, capital gains will be allowed to be invested in these opportunity zones for a deferral. What happens if you have gains that are subject to recapture?
As presently written, remember that short-term capital gains, long-term capital gains are subject to the deferral. You can defer that. If you have 1250 or 1245 gains, that's treated as ordinary income, and that's not going to be allowed to be subject to the deferral. So you have to pick that up into the year of the sale. However, when you talk about, we kind of, I think, maybe just to go back and revisit a little bit, this deferral is allowing you that if you hold it for more than 5 years, you get to defer 10% of the gain. You get to defer the gain, and 10% of it is excluded. You hold it 7 years, it's 15%. And then after 10 years, any future appreciation outside of that gain is not subject to additional gain. So what it says is that if you wait that 10 years and you would have had depreciation recapture, that's not going to be subject to recapture and ordinary income. And in fact, you're not going to have to pay any tax on that future appreciation after year 10.
Let's go back to substantial improvements. So especially in the real estate area, you have construction and rehabilitation projects that may exceed the 30-month threshold.
This was not something that they addressed in the proposed regulations. There are no provisions that would allow improvements beyond that 30-day period to qualify. There was a real estate roundtable that sent a letter to the Treasury Department in June of 2018, and they have a suggestion that the Treasury allow for an extension of the 30-month period if there's an unforeseen circumstance, such as the weather, labor issues. So there's going to be additional regulations surrounding this opportunity fund and opportunity zone funds, and probably within those new pronouncements, we might get some guidance with regards to that.
So now let's move on to the actual opportunity funds themselves, and then there are some open items or some things that are still being kicked around a little bit. So the first one is, what is going to qualify as an addition to basis for property in an opportunity fund?
So the improvements to the building itself is going to increase that basis. There's been some discussion with regards to anything over and above that or funding. That has not been determined as of yet, and they're still working on those regulations. But if you think about it, when you buy a piece of property in the opportunity zone and that property has land and building, then your substantial increase in value is just based upon the piece of the building, and you have to take that building value and put more cash into it to make those substantial improvements. That will constitute more basis. Okay?
Another question that's been raised is, how does a fund handle working capital requirements?
The working capital requirements was addressed in the proposed regulations, and what they were saying is that non-qualified financial property excludes a reasonable amount of working capital. So remember, if you're going in and you're substantially improving your property, you're going to have substantial cash on your balance sheet, cash equivalents, or some debt instruments. And as long as they have a term of 18 months or less, the working capital is considered reasonable. And the reason you need to do this is because you have to make sure that you have the assets of substantially all of the assets equal to 70%, is that the amount is designated in writing that is for acquisition, construction, or substantial improvement to the tangible property. There has to be a written schedule consistent with the ordinary startup of a trade or business, and the assets are spent within the 31 months of the receipt of the cash. And the working capital assets are actually used in a manner consistent with what your written statement has.
Another item which they mention is one of the rules for the fund is that 90% of the property must be in the qualified opportunity zone. That basically is certified at 6 months after and at year end. What if you can't meet the 90% test? What would be a reasonable cause?
That was not addressed in the proposed regulations. In fact, the certification or the statement that you have to put onto your tax return has it within its instructions that a notice from Treasury is going to be issued that will define what they will constitute as reasonable cause, and therefore that notice hasn't been released yet. More than likely, it'll be your normal reasonable cause that, relied upon service provider, or if there was extraordinary events that occurred. But until those regulations are out, we have to see what reasonable cause is defined by the government.
The rules for the fund have these measurement dates. How does the averaging work? Is it fair market value? Is it original basis? Is it unadjusted basis? Is it adjusted basis? Is there anything out there?
Well, let's not get crazy, right? Okay. With regard to that question, if you have financial statements that are issued, then the values are that which is on the financial statements, okay? And it's the unadjusted basis. If you do not have financial statements, then it's going to be cost basis, which is the original cost basis, which is unadjusted as well.
Okay, an item that's really been a hot topic in this is the government never creates a code section without referencing another code section. So the question is, does leasing residential real estate constitute a qualified opportunity zone business, as these new rules reference some old rules in section 1397C, which states a qualified business is not residential rental property?
Okay, that was a mouthful. There's been a lot of discussion around this. It is a very critical issue. Number one, the real estate roundtable that sent a letter to Treasury in June asked for clarification of that. Even clarification to the point that residential real property may not qualify for a qualification in the opportunity zone situation. And therefore, they're asking for that to be cleared up, because to Ray's point, it was stated within 1397. However, with much discussion between Ray and myself, reading a lot of commentary that's out there, and even looking at the funds and what they're investing in. I mean, they're investing in high-rise residential property, and even the purpose of this opportunity fund is to encourage underdeveloped areas that are suffering, to bring jobs, to bring housing, etc. So one would think, in reading all of this, that what they're getting to is that as long as it's a qualified trade or business, then whether it's residential or not should qualify. I believe that, and this is obviously just my own editorial on this, and until regulations come out clearly defining it, I believe that it's really those that are personally investing, that they just don't get invested in some passive activity, that it has to truly be a qualified trade or business, and therefore someone like a real estate developer, a real estate professional, they should be able to do it. But if somebody just is going to be a passive investor in a triple net lease, then more than likely that's not going to qualify.
We'll just talk about this substantially all. Has somebody come out with what really is substantially all?
Well, there's been a lot of discussion with regards to it, and the way that, in reading through the literature, the regulations, and commentary, it appears that substantially all depends on whether it's a direct investment or an indirect investment. So if it's a direct investment, then it's 90%. If it's an indirect investment, 70%. So you have to look to see how you're investing in the qualified opportunity zone and whether or not you are directly investing, so that means 90% of it. And if you're not, you're doing it through, let's say, a corporation, partnership, and then through the fund, then it would be 70%. That's not determinative as of yet, but that appears to be the understanding within the regulations.
Another item they've been kicking around is the term separate funds. So when a qualified opportunity fund receives money, more likely than not, they're going to receive the funds, obviously, from people's deferred gains. But people may also want to contribute non-deferred gain money just to be part of a project. How is that treated, given the exclusions and deferrals of gains and the big deferral in terms of if you hold it longer than 10 years, you can escape any type of tax on appreciation?
And that's been discussed within the proposed regulations and been talked about by the law firms, et cetera. And it appears that if you put any new money in that has nothing to do with the deferred gain that you originally sold your stock for, sold the partnership interest, sold real estate, so whatever that gain is, and you put that money in, that's the piece that's going to be subject to the 15% exclusion after 7 years, and then after 10 years, any future appreciation will not be subject to the gain, but any amount of money that you put over and above that will not be subject to the non-recognition of tax after the 10-year period.
Another area that they're kicking around is the coordination with the partnership rules under subchapter K and how you would handle basis issues regarding debt, new money, and what the basis in the funds is.
And to Ray's point, it's clearly stated that the Treasury has not addressed this issue, that they probably will be addressing it in its next rounds of regulations, and as of yet, there's commentary out there, but no one really knows the answer to that question.
The last two items, the first one has to do with original use. Again, how is that going to be defined? What happens if somebody purchases refurbished equipment or property has been vacant for a period of time? And also, is there any discussion with, instead of purchasing equipment, you decide to lease it?
Within the proposed regulations, they did have an example in there that if a property was vacant, if a real property was vacant for 1 year, that you could assume its original use. Not very clear in its conclusion, however, it kind of makes sense that if you have vacant property and now you don't need to rely upon the substantial, improvement test, its original use test. However, more than likely, if it's been vacant for a year, you're going to have to put some money into it anyway. So I think you're going to have it as a backup that you can use it as original use. However, you're more than likely going to put substantial investment in it. As far as tangible personal property, because remember, this code section, we keep talking about real estate. This code section is allowed for a gain on the sale of publicly traded stock. It's partnership interest. If you invest in a company in the qualified opportunity zone, a partnership that's operating in a business in the opportunity zone, and if you buy real property and tangible property, will you be entitled to this deferral and exclusion? There's nothing out there with regards to tangible personal property and whether or not you can reclassify it as original use. That's yet to be determined.
And the last piece, for people who are thinking of going into funds, is obviously the fund has these testing periods, and if they fail, the fund potentially could be penalized. But what happens to the investors who are deferring their gain?
They talk about the penalties regarding the fund, which is that they have to have, there's a form that you fill out, and you have to do the 6-month testing period and the end of the year testing period for where the assets are located and the use. And if you fail that, then you're going to get hit with a penalty. There's been no discussion as to what happens to the investors. And most commentaries are saying that, you know, they've alerted the Treasury to this issue and will probably come back out with new regulations to address specifically that.
Okay, so that's where we're at now. What we'd like everybody to do is take out a pen and paper, and we're going to do a little bit of an example so everybody can understand. So again, we're taking a deferred gain. So if we look at the screen here, everybody's saying we have a deferred gain. Somebody's deferred gains on Microsoft stock. So say they bought it for $100,000, they sold it for $300,000, they have a $200,000 gain. You can take that $200,000, and it doesn't necessarily have to be the gain money, it just has to be money that is equal to what the gain was, and invest that in either a qualified opportunity zone or a qualified opportunity fund. You need to do that, again, within 180 days of when the gain occurred. You will then be able to get a deferral, and you will not have to pay tax on that gain until the earlier of A, the fund basically disposes of what they invested in, or 2, December 31st, 2026. There's 2 other perks in there. If you hold the property for 5 years, the government is going to give you a 10% exclusion on that gain. So in this example, the Microsoft $200,000 stock gain, they'll give you an exclusion of $20,000 if you hold the property in the opportunity fund for at least 5 years. If you hold the property for at least 7 years, they'll give you another 5% for a total of 15%. So you can get a maximum of exclusion of $200,000 times 15% or $30,000. So hence you would pay tax on $170,000 in 2026, or for the tax year ended December 31st, 2026. So you can then escape taxes on 15% of your gain. The other bonus that is out there is if you hold the property for 10 years, any economic gain, i.e. any gain in excess of what the deferred gain that you put into the investment and you paid tax on, will then be excluded. So again, keep it simple. The $200,000 gain goes in, you hold it 10 years. After year 7, you pay the tax on December 31st, 2026. You would pay that on 85% of the amount, or $170,000. And then if you subsequently, after 10 years from your original investment, sell that property for $1 million, there'll be no tax on that gain at all. So we have an example on the next page, which hopefully should really lay it all out. So George has a $200,000 gain on Microsoft stock. He sold that stock on July 1st, 2018. George then buys an interest in a qualified opportunity fund on November 1st, 2018 for $200,000, the same amount that his gain on the Microsoft stock was. The original gain, i.e. $200,000, he doesn't have to pay any tax on that in 2018. He will pay the gain on that when he exits the opportunity fund. And if he doesn't exit the opportunity fund, Then on December 31st, 2026, he will have to pay tax on 85% of the original gain, i.e. the $200,000. So he'll pay it on 85% of 200, which is $170,000. When that gain is paid, it's paid on the original character of the gain. So if George's $200,000 gain on Microsoft stock in July 1st, 2018 was short-term, he'll pay short-term capital gain taxes in 2026. If it's long-term, he'll pay long-term capital gain rates.
Just to interject here that everyone needs to be mindful of, it will keep its character, but if the tax rate in either of these areas, short-term or long-term capital gains, changes in 2026, then you will pay it at the then enacted rate for that year. So you won't go back to what it is today, you'll use the rate that's in 2026.
If George doesn't need to take any money out of the fund to pay his tax bill on the deferred taxes in 2026, and he leaves it there until 2029, so he's now invested over a 10-year holding period, if he sells that investment for $1.2 million, there'll be no tax on that gain when he sells out of the Opportunity Fund. So that will completely escape tax. It's called a permanent exclusion, and this is where the big benefit is for these opportunity zones. So we have a little timeline on the slide, as you can see. So on July 1st, 2018, his gain triggered. Rather than say, I'm going to pay tax at that point, he's going to take the gain, the proceeds of the gain, and invest that into a qualified opportunity fund. And he will hold it for at least 2023, and then he'll get a 10% deferral on the gain, or exclusion, I should say, I apologize. And then if he holds it another 2 years, he'll get another 5%. And then if he continues to hold it, he pays the tax on 85% of the amount on December 31st, 2026. If he continues to hold that investment, any increase after his tax is paid on the original gain back in 2018 escapes tax. It's a permanent exclusion.
But keep in mind that if you want to hold it indefinitely or for a longer period of time than that 10 years, when that tax comes due on December 31st, 2016, and you have to pay Uncle Sam, that money is coming out of other assets, because then if you have to liquidate the Qualified Opportunity Fund to pay your taxes, then you're not going to, have that permanent deferral after year 10.
So I think this might be a good time to just talk a little bit about, hey, what are my deferral opportunities? So now we have this qualified opportunity zone. The other mechanism that real estate people love to talk about is 1031 exchanges. There's also small business stock for 1202 and also 1045. So the big piece is really 1031 versus 1231, opportunity zone versus 1031 exchanges. That's basically the meat and potatoes of this whole tax law. So to compare the two, we should just basically just go down and look and say, okay, what are the differences? So the first piece would be, what property qualifies for a deferral?
First of all, we're going to compare 1031 to the Opportunity Fund investment. If you think about it in terms of what property in a 1031, they've now limited it whereby it can only be real estate. Whereas in an Opportunity Fund investment, it can be the sale of real estate, it can be the sale of stock, it could be the sale of partnership interest. So it's a lot more pervasive in its qualified assets that can be used to defer the gain. Number two, one of the differentiators, if you will, is the rollover. In a 1031 transaction, you have to roll over the entire proceeds. So if you sell a piece of property for $10 million and it's got debt of $4 million, you still have to roll over that $10 million. Whereas in the opportunity fund investment, you're able to just take the gain on that and roll that over into an opportunity fund investment. But remember, you still have to have the cash outside of the fund to pay the tax when it comes due in 2026. Number two is that what kind of capital gains deferrals, capital gain tax payments on the initial investment may be deferred indefinitely, whereas on a 1031. Whereas in a tax opportunity fund investment, that deferral is until December 31st, 2026 is when you actually have to pay the tax. So the 1031 is clearly more beneficial in that area. Capital gain tax reduction, you're going to get a reduction in the opportunity zone because you're going to be able to deduct or completely eliminate the gain of 15% if you hold it for more than 7 years. And then anything thereafter the 10-year period, the entire appreciation in economic value. Whereas in a 1031, there is no capital gain reduction. It's just a deferral. The last one is the capital gain tax on final sale. You're going to owe the capital gains tax on the final sale of the asset, whereas if the investment is in an opportunity zone is held for greater than 10 years, again, there is no capital gains on that. Older taxpayers, the one possible thing is if you hold it until death, you'll be able to not have any gains to pay on that asset because you've held it to death. Of course, obviously, you'll have the inclusion in your estate depending upon the ownership structure. But in the opportunity zone, if you hold it long enough and you transfer it to your children, then you would be able to do some estate planning on a high asset value basis and be able to transfer that to the children without having any appreciation within the asset itself.
Okay. The main piece to just get through with these opportunity zones is basically people need to understand that it's an opportunity zone, an economically distressed area. So this is something that should not be taken lightly. There are lots of commentary out there that it could be a great investment vehicle for people who are looking for a socially redeeming investment. Again, these are people that have significant dollars to invest and diversify their portfolios. There are two types of areas that basically they're looking to help out. Obviously, there's the city area, and then there's the rural area. Everybody sees in the news that Amazon put their headquarters into Long Island City. Amazingly, Long Island City happens to be a qualified opportunity zone. So some people may or may not believe that Jeff Bezos could have a deferred gain that he's looking to reinvest, so he may be purchasing property in Long Island City and will build a building that he will then lease back to Amazon. That works for someone in his financial well-being. For the average investor, you would need to look at a lot of different types of things. If you don't go into a fund itself, you would need to look at, will they be updating the public transportation area in that location? Do you think it will come back? How is it going to work with basically upstate New York if we're just going to deal with New York area? Is it going to reach the Buffalo area, or is it really just going to be in the 5 boroughs? There's a lot of things that people really have to consider before they just jump into these opportunity zones and these opportunity zone funds. But it is a unique opportunity to potentially really invigorate and invest in the economically distressed areas in the country using private capital.
The one thing that I want to interject here is that we've had conversations with some investment managers, some people in the real estate industry, et cetera. Keep in mind the following, okay? Right now, we have clients that are in the opportunity zone that probably get 6 or 7 phone calls a day. So the prices that they're throwing out there for these properties may not necessarily be fair value. So if you're paying an appreciated value today, that gain that you think you're not going to have to recognize 10 years from now may not be what you think it is. So you have to be very, very careful with the prices that you pay. The investment houses that we've spoken to are leaning more towards, not setting up funds per se, but to do a one-off alternative investment depending upon that person's portfolio, and having them go and buy either, an opportunity zone business, opportunity zone property, but have it a single asset that they're swapping out for the gain that they needed to recognize. If you put it through a fund, keep in mind, you now have become a minority, possibly shareholder in a fund, and you don't have any say or control necessarily within that fund, and you've lost control. So that's another downside to being in an opportunity zone fund. And lastly is that, you have to take into consideration that they are in depressed areas. You're banking on that depressed area, being a home run, if you will, 10 years from now. But if it's not, then you held up your asset there for 10 years, and there may or may not be any gain in it if you've overpaid today. So they're kind of saying, let's, take a slow down of what's going on out there, be very careful in what your investments are, and be mindful that the gain will be taxed at 85% in 2026. And the only potential for this is that if a future appreciation in economic value occurs.
So the last slide, I just want to take you through again, if you leave nothing with this, I just want you to understand again the 3 potential benefits to these opportunity zones and how they stack up against other deferral mechanisms. So basically, the first thing is gain deferral. If I have a gain today, I can defer paying that capital gain, the tax on that capital gain, until 2026 if I hold an investment that I make into a qualified opportunity zone or a qualified opportunity fund. Number 2, I can potentially, depending on how long I hold that gain in the new investment, I can defer up to either 10% or 15% of that, or I exclude up to 10% or 15% of that gain. So if I hold that new investment for 5 years, I can exclude 10%. If I hold it another 2 for a total of 7, I can exclude another 5% for a total of 15%. And then the big bogey is I could potentially get a permanent exclusion on the economic gain if I hold that investment for 10 years at a minimum, and any future appreciation will not be subject to tax. That is the main benefit of these opportunity zones. But again, understand where you're investing. You're investing in an economically distressed area, and you need to hope that it's going to come back in order for you to realize that gain. There are 2 other ways that people look for permanent exclusions of gains. One is with the 1031, where basically you sell real estate and you buy another piece of real estate. 1014 is the step-up date of death section. So you would need to hold the property till your date of death. Then you would escape the capital gain, and then you just have to deal with estate taxes, whatever your situation may be. Or you can just take the gain and invest it in an S&P fund and just hold that until, again, date of death, and then all of those gains will escape taxes, income taxes, but you will then have the estate taxes on that.
And the other thing to remember is that if you hold the investment and the person should pass away prior to paying the tax, it's still considered to be income with respect to the decedent, and that tax will be paid by the estate. So you're not going to escape it, it's just a deferral as well.
If anybody would like to discuss this further, or you have any further questions, feel free to contact either Alice or myself, and we'd be more than happy to go through this with you. Hope this was a learning and enjoyable experience for you all.
And that concludes our webinar for today on Qualified Opportunity Zones. Thank you all for joining us. We will be sending a copy of the presentation and a recording of the webinar to all of you within the next few days. Please also look out for an invitation on a live seminar that we will be hosting on Long Island about Qualified Opportunity Zones. Thank you and enjoy the rest of your day.